Howdy, Jacob here. Today we're looking at Carpenter Technology Corporation in the metals and mining industry. 6.9 billion market cap on about half a billion greater enterprise value. They engage in the manufacture, fabrication, and distribution of specialty metals in the US, Europe, Asia Pacific, really globally. Founded in 1889. They've been around a heavy minute. 2.2 billion in revenue in 2015 to 2.7 billion, but we are seeing heavy cyclicality dropping 19% in a year to gaining as much as 39% a year. Gross margin and operating margin, same story, very volatile, as low as negative 12% and as high as 13% on the operating margin side, as low as essentially 0% on the gross margin side, and as high as 21%. So the dividend is very consistent, however, and I'm sure in relation to its average earnings and free cash flow, it's hopefully not too bad. And their return on invested capital is pretty poor, so no surprise to me. They're handing money back to the shareholders through a dividend. Cost of goods sold, very volatile. Sales, general, and admin, it's the only thing consistent about the business. Almost 200 million cash on hand with no short-term debt, 694 million long-term debt. So 700 million long-term debt in relation to free cash flow. I mean, it's really all over the place here. That their cash. So when years are great, they pocket a bit of cash so that they don't have to go into debt, which I do like. And it looks like they haven't really gone to debt since 2020. And so I'm probably fine with where their debt situation is at right now. I mean, they do have to pay out some debt at some times because they pay a dividend that's 40 million fixed, but I don't think that's really that immense in relation to their cash on hand and their free cash flow that they get on average. So I'm probably fine with that debt. I mean, with this very cyclical business, I do prefer little to no debt because, again, you can make $1 billion, you can lose $1 billion. I mean, yeah, the odds are in 50-50. It depends on the market and everything, but it's really tough to have even a bit of debt when you don't consistently make money. But the amount that they have, I don't think I'm concerned about. So let's start making our assumptions here on the revenue growth side. This is one of those businesses. I'll just do 3 and 13. Again, my logic is I think it'll grow essentially with inflation, and I think that it'll probably have a premium that's less than the market due to inconsistency. I think people that invest love consistency, whether that be earnings, free cash flow, a dividend, whatever it is. I think their dividend's safe, but I think their cyclicality of earnings is really going to affect the average investor's mindset to invest in this company. So I think it deserves a lesser premium. Share change, I guess it just offsets stock-based compensation, 20 mil. I mean, it's really not doing anything, so I'll just say nothing. Dividend, keep that the same. Yeah, we're saying it needs to fall 90% before you get the return you look for here. I think it's way too much of a premium at this price. So way too expensive for me. Way too many other companies I think are more appropriately attractively priced with way more opportunities. For me, I could be silly as a goof, or maybe I don't know anything about the business, probably the case. But to me, with what I'm seeing, not even close to anything that I'd be buying at this price. Hope you enjoy the video. Have a great day.